As we progress through the second quarter of 2026, the global credit landscape is undergoing a transformation that historians may eventually define as the Great Bank Retreat. The primary catalyst for this systemic shift is the final implementation of the Basel III Endgame. These are not merely suggestions, they are a sweeping set of international regulatory standards that have mandated traditional commercial banks to drastically increase their capital reserves. For the average borrower, this represents a liquidity squeeze, but for the institutional investor, it is a massive structural vacancy. Traditional lenders are no longer simply being cautious, they are being mathematically excluded from the mid-market lending space. By de-risking their balance sheets to meet new, stringent liquidity coverage ratios, global banks have been forced to abandon billions in high-quality corporate debt opportunities that they would have dominated just 5 years ago. This isn't a temporary cycle of high interest rates or a fleeting moment of market volatility, it is a permanent, tectonic shift in the architecture of global finance. Into this vacuum, private credit has surged, evolving from a niche alternative asset class into a $2 trillion juggernaut. We are currently witnessing the birth of a new, buyer's market where non-bank capital providers now hold the keys to global corporate liquidity. What follows is a comprehensive analysis of how this retreat of legacy institutions has paved the way for the rise of private direct lending as the primary liquidity conduit for the 2026 market cycle. To understand the wealth flow of this decade, one must first understand the vacancy left by the bank. To understand why private credit is currently outperforming traditional fixed-income markets, one must look closely at the yield engine. Unlike traditional bonds, which often face significant headwinds in volatile or rising rate environments, private credit is primarily constructed on floating rate structures. These loans are typically pegged to benchmarks like SOFR, the secured overnight financing rate, ensuring that as market rates fluctuate, the lender's margin remains structurally protected. This provides a sophisticated, natural hedge against inflation and interest rate volatility that standard government or corporate bonds simply cannot match. However, the real profit driver, and the reason for the significant spread over public markets, is the illiquidity premium. Investors in this space are compensated with substantially higher yields in exchange for holding these assets to maturity, rather than seeking daily liquidity. In the 2026 landscape, this premium has widened significantly. Corporate borrowers now value the certainty, confidentiality, and speed of private execution far more than the slow, bureaucratic, and often public hurdles of traditional bank syndication. Furthermore, the wealth flow strategy relies on senior secured positioning. By sitting at the very top of a company's capital stack, private lenders hold first priority claims on the borrower's tangible and intangible assets. This creates a unique risk-reward profile, achieving high single-digit or even low double-digit yields, while maintaining the kind of downside protection previously reserved for global investment banks. In an era where traditional yield is scarce, this combination of floating rate protection and asset-backed security has made yield engineering the new baseline for institutional wealth preservation. We are currently in the midst of the most significant capital expenditure wave in human history, the build-out of global artificial intelligence infrastructure. Financing this unprecedented expansion requires a scale of capital that legacy credit markets are fundamentally unequipped to absorb. As hyperscalers and sovereign nations race to secure the compute power and energy resources necessary for digital dominance in the 2030s, they are turning away from traditional equity and bond markets towards specialized private capital. Financing a $10 billion data center cluster is a complex logistical and financial feat. It requires more than just a standard loan. It requires asset-backed private credit that understands the technology. Private lenders are now the primary financiers for everything from the procurement of advanced silicon, specifically the latest NVIDIA B200 and Blackwell clusters, to the massive energy infrastructure and liquid cooling systems required to keep them operational. This represents a brand new, high-growth asset class where the underlying collateral is the literal physical backbone of the global digital economy. For the first time in financial history, we are seeing infrastructure-grade security paired with tech sector returns. This isn't speculative software, this is hard asset lending against the essential infrastructure of the future. As AI integration moves from centralized clouds to the edge of the network, the demand for this specialized credit is projected to be the primary driver of institutional portfolio outperformance for the foreseeable future. If data is the new oil, then the infrastructure that processes it is the new midstream asset class for savvy credit investors. However, a sophisticated briefing must also address the maturation of the cycle and the emerging reality of shadow distress. The rapid, almost frantic influx of capital into the private debt space over the last 24 months has led to inevitable pockets of overleverage and poor underwriting. In the 2026 cycle, systemic risk is rarely found in the public markets, which remain under heavy regulatory scrutiny. Instead, it is found in the shadows, within the private, bespoke agreements where traditional transparency is often obscured and covenants can be negotiated in the dark. We are currently observing a rise in liability management exercises, or LMEs. These are creative maneuvers where distressed borrowers attempt to prime existing debt, reshuffle collateral, or strip assets to find short-term breathing room at the expense of existing lenders. In this environment, the difference between a high-yield success and a total loss is the clinical quality of the original underwriting. This module emphasizes that success in this phase of the cycle is defined not by the volume of loans you originate, but by the ones you have the discipline to avoid. We examine the critical importance of maintenance covenants over covenant-light structures. As corporate borrowers become more aggressive in their debt shuffling tactics, elite private credit firms must respond with even more rigorous, asset-backed protection. We are seeing a return to the fundamentals of senior secured lending, where the focus is on tangible collateral and clear cash flow waterfalls. Surviving the shadow requires a rejection of the easy money trends of the past decade and a return to the professional, cold-blooded execution of risk management. In the 2026 market, protection is the ultimate profit. The conclusion for 2026 is definitive and unavoidable. Private credit has transitioned from a fringe, alternative asset class into the permanent backbone of global corporate finance. The structural shifts we have analyzed, ranging from the regulatory-driven retreat of legacy banks to the hyperscale AI infrastructure boom, are not temporary anomalies. They are the new permanent pillars of global capital flow. The era of the generalist commercial bank is fading into the background, replaced by a new era of the specialist private lender who deeply understands industry nuances and the complex mechanics of risk. For the institutional investor and the visionary brand builder, the priority is now yield engineering. This is the sophisticated ability to manufacture superior, risk-adjusted returns through direct, high-level, and secured lending. As we move deeper into this decade, the winners will be those who control the flow of capital in an increasingly bankless world. The Wealth Flow Briefing has provided you with the architecture of this new market. The successful execution of this strategy is now in your hands. Precision in underwriting, clarity in institutional strategy, and the courage to fill the massive liquidity void left by legacy institutions will be the defining hallmarks of the next generation of financial leaders. As traditional systems continue to deleverage, those who position themselves as the new conduits of liquidity will capture the lion's share of the 2026 market cycle. This concludes our private credit master briefing. Use this data to refine your strategy, protect your capital, and position your portfolio for the structural shifts ahead.